if you think about the continuum or life cycle of a private equity fund, you have early years, you sort of have midlife, and then you have the tail or the end of life. We can buy the same fund at different points in time. The portfolio looks very different from year to year. Assets get sold, new companies are purchased during the investment period. After the investment period, assets get sold, assets get written up, some assets get written down. So you have to re-underwrite these things on a quarterly basis. And we have the ability to take a fund that might be second or third quartile and at the right price, turn it into a first quartile type return for our LPs. So it's a different way of thinking about investing in the private markets.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. Today's episode dives into the rapidly expanding world of secondaries with a senior leader at one of the pioneering firms in the secondary space. We sat down at Franklin Templeton's New York office with Taylor Robinson, a partner on the secondary team at Lexington Partners, which has over $76 billion in AUM and is part of Franklin Templeton's family of private markets funds and strategies. Taylor, who joined the firm in 2008, is primarily focused on origination, evaluation, and execution of secondary opportunities, including partnership and GP-led transactions. He's also a member of Lexington's ESG Steering Committee. Taylor and I had a fascinating conversation about the current state of the secondaries market. We covered many of the hot-button topics and trends that are shaping the secondaries market, including why secondaries have become an integral part of many LPs' portfolios, how secondaries have become a portfolio management tool for LPs, the rising GP-led secondaries, why not all CVs are created equal, why secondaries can be a good on-ramp to private markets for wealth channel investors, and what the future holds for secondaries. Thanks, Taylor, for coming on the show to share your expertise and wisdom about private markets and secondaries.
In a collision of culture and finance.
We're going mainstream.
So would love for you to walk us through your background, because I think it's so instructive as it relates to the evolution of your career, Lexington, as well as the evolution of the secondaries market.
So career-wise, started my career in 2005 at JP Morgan in the investment bank. I was in leveraged finance, left there in 2008 to join Lexington Partners. And so I've only had two jobs, pretty good. An investment banking analyst, started in '08 at Lexington. I think what was interesting to me at the time was I was in a place where at JP Morgan on the leveraged finance side, we were working on some of the biggest buyout deals. It was sort of the biggest franchise in leveraged finance, high yield and loan. And the world was starting to fall apart. You were coming into what was, I don't think anyone at the time knew how bad it would be, the financial crisis, but it was a market that was very liquid until it wasn't. I think it would be sort of revisionist history to say I knew enough at the time that secondary would be interesting, but I do think I had a sense that to provide liquidity to an illiquid market would be an interesting thing. And then I happened to know some people who did this kind of boutique-y cottage industry investment strategy of secondary private equity, one of whom was the founder at Lexington who I'd been introduced to. And so I kind of chased him for an interview and chased him, and he finally relented and accepted. And it was a much smaller firm then. And I think the interview process was meeting with a series of people over a series of months. It was nothing structured. And so that was 18 years ago. And look, it's been a fantastic journey at Lexington. I'm sure we'll talk about that. But that was the origin story. And so for 18 years, I've been doing the same thing.
So that's a great jumping off point, because I think Will, who's one of the founders of Lexington, said on Hugh's podcast from Hugh from Bain that I think it was maybe 20 something years ago, or maybe a little more, like $1 billion of volume was being traded in secondaries on a per deal. Like that was a big deal.
Yeah.
Today we're at, I think, close to 200 billion.
I think when it's finally printed last year, 25 will be over 200 billion.
Okay, so
yeah.
Massive growth. What was the secondaries market like in 2008 when you joined?
That year, I think the total volume was about $9 billion globally. You'd probably go back 25 years to a point where it's about $1 billion a year. And our firm was around at sort of the big bang that created this market. We're one of one or two or three firms that have been around since the very beginning. The firm's origins really go back about 35 years. 2008, because that was the year where we started going to a financial crisis, pricing in our market really gapped out. So in other words, and we will talk about it, but discounts got huge. No one knew how to price risk, and volume dropped way down to about $9 billion globally. The world needed liquidity, wasn't really sure how to price that risk. And then what happened was we sort of muddled through the financial crisis. And then you had this 11-year stretch with almost zero interest rates globally. And that was like throwing fire on the fuel that created this massive private market boom that we're in and kind of working through today as a market. So I think that was sort of the accelerant that created the explosive growth in the private markets over the following decades. So, it was like, I haven't ever used this analogy, but if you think about like, burning a field so that there can be green shoots and new growth, that was that. And then the market just grew tremendously. And the real fuel of that was zero interest rates and capital around the world flowing into the asset class.
I think that's a great analogy to bring us to where we are today, which is where, particularly on the institutional side, there's been a lack of distributions and liquidity for many institutions. There's also structural challenges for some of those institutions where they've needed to sell for various reasons. You then have the GP side. GPs need to provide liquidity to LPs because they're demanding it, or they have assets that go beyond fund life. So there's all sorts of aspects of the secondary market today that make this a big and growing market. What aspects of the secondary market today do you see as being the areas where you're focused on most, or your LPs want you to spend most time on?
Well, as one of the biggest firms in the market, we do it all. If you think about our business in terms of the deployment of capital and or the capital we raise, the majority, 2/3, 70% is what you would think of as traditional secondary deals, buying diversified portfolios from endowments and pensions and foundations and the like, underwriting all of the assets in a portfolio and going and working with the seller to become the replacement LP in those funds. That's bread and butter secondary. The other third of our business is doing what are today called GP-led deals, where we are working with one private equity firm around either a single asset or multiple assets or a strip of assets to create liquidities on behalf of their LPs. Or I should say create liquidity for their LPs. But it's the GP making the decision about what assets go in and sort of the price, not in a way that is coercive, but in a way that effectively gets the LPs in the fund what they want at a price that makes sense, where they have the option to either take liquidity or not. So they're sort of complicated deals. But what's driving all of it is a need and want for liquidity, right? And I think, and I hope we touch on, the theme in the markets today is going back to that 11-year period I was talking about, with low interest rates where capital was flowing towards, higher yielding asset classes, which are the alternatives. And it's hard to call them alternatives when you think about the size of this market. That created this huge growth in the inventory of stuff. And I just say stuff because it's easy, but everything that sits within funds, where that capital is today locked up, and that inventory of assets is tens of trillions of dollars. and it has outgrown its traditional sources of liquidity. And, just to give you a little context, if you think about where the market was and where it is today, if you were the CIO of a pension fund and in 2021, you had a 15% allocation to private equity. You might have heard us say this before, but it's the truth. And you ask that CIO, what's the challenge? And they would have said, well, the challenge is staying at 15%. The money's coming back too fast. It's the and by the way, during that period of time, private equity firms said, well, boy, if the issue is staying invested, I'll just raise bigger funds faster and faster. And so the market grew really fast. Then in 2022, the cost of capital changed and liquidity slowed down, and the IPO market everything slowed down. And we're now in year 4 of that real slowdown. And so if you had a diversified, mature private equity portfolio in that prior era, it was spitting off about 25% cash versus your starting NAV over the course of a year. But over the last couple of years, we've been between 8 and 12%. And so it's off 2/3. And so that is the catalyst for the real explosive growth of our market over the last couple of years. It is a need and want for liquidity.
When I hear you talk about that, my mind goes to the CIOs at these institutional LPs. They need to actively manage their portfolio.
Yeah.
How do they think about that given the deck of cards that they have to play today, given their portfolios and what you just shared about the distribution rate being lower than it was? Maybe they want to stay invested in private markets, and then they need to hit their allocation levels as well. But how does that shift change how they have to think about managing their portfolio and also partnering with a secondaries firm to do that?
It's an interesting question. So if you go back, you asked about 2008, or even 2010 or 12. If you go back 10, 15 plus years, what was typical in the market then was you'd have that CIO say, okay, we need to divest. What was often sold at that point were funds managed by firms where they were effectively severing the relationship, and you had sort of a negative selection of assets into the secondary market. Where we are today, it's very different. It has become that active management. And we as a market, and certainly we at Lexington, have spent, decades doing the evangelical work of going out and explaining to LPs in the market why this is important, and to GPs in the market as to why this is important. And what is happening today is it's more of a positive selection of assets for sale. So you may have, a large pension fund, instead of bringing 10 funds, which is the portfolio that needs to be sold and they're looking for the best price, they might bring 100 funds because they've built this massive portfolio. And that 100 funds may represent $10 billion of exposure, and they may come to the market with an advisor and say, we want to create $2 billion of liquidity. You, the market, pick and choose what makes sense to purchase. Oh, and by the way, we don't need to sell 100% of each fund because we actually want to take the proceeds here and re-up with the same managers. So it may be we'll sell 50% of that fund and 75% of that fund and 25% of that fund. So it's more of a menu, and we as buyers have to have all of the information on all these funds, the ability to underwrite it, the ability to transfer it, to pick and choose what we want from a huge menu to create a deal that works for us and for the seller.
So if I listen to you talk about that, as an LP in a secondaries fund like Lexington, where are you then gaining edge or driving returns for your LPs? Has that changed as well, given the change in the market structure?
So are we, Lexington, driving edge for our LPs? Look, I think our job is to maintain and create the largest funnel of potential opportunities for our LPs. And so to do that, we need to have a huge amount of information. This is a private market where information flows asymmetrically. We need to have all of the relationships that allow us access to that information. And then we need to have the most experienced team in the market, which I really think we do, having had no turnover over the years. And our job is to look through this huge funnel of opportunities. Remember, the secondary market probably sees annually, on average, twice as much deal volume as what ultimately trades, which says it's pretty undercapitalized. And then our job is to look through all of that and have the experience and the process and the people and the information to do, 2 to 4% of the deals we see on an annual basis. So it really is about people, and it's about process. It's about information access. It's very different than direct private equity, and it's certainly different than the public markets in terms of investing.
How do you think about evaluating and partnering with GPs, particularly if we take the current moment? GPs need to probably work harder to generate returns because interest rates are higher. Yeah. You have to create value. So in this kind of get fit era for private markets for the GPs, you talk about seeing this massive funnel of opportunities. How do you think about partnering with GPs, evaluating the GPs that you want to work with based on, we've gone from an era of easy money, low rates to now a different time period in terms of what it looks like for a GP to create value?
A couple ways to answer that. I mean, directly, we're partnering with GPs in these GP-led deals. Look, we have the fortune of having been around for 3.5 decades as a firm. And most of the GPs are out there. They go through cycles. Not every GP always has first quartile funds. Part of our job, and this is really the qualitative part of our job, and there's a quantitative aspect to it in that we have to reflect it through our underwriting and maintain data on performance, is knowing where a firm is and where their assets are within the life cycle of that firm and then the broader kind of market cycle. And so, for instance, knowing which private equity firms get a little more aggressive with the way they mark assets before they bring a new fund to market, or knowing which firms generally hold assets very conservatively and then try to sell them at a real sort of uptick to where they were held in the last mark before the sale. All of that is important for us as we go out and price this stuff in the market. But it's a really nuanced business. A lot of this is knowing the firms, and knowing not just the firms. When you're talking about single asset continuation fund deals, it's knowing the partner at the firm who's leading the deal. And it's I tell people that we're in the alignment business because we, Lexington, we don't control any of the assets. And we build this massively diversified portfolio, but there's always another private equity firm between us. And I say private equity, but I mean private equity, growth, venture, all of the different strategies. There is a general partner who controls the asset ultimately. And we need to make sure that we are aligned with that manager. And then the other nuance of our market that you have to keep in mind is we have the ability to reprice the asset class. So what's fun about it is if you think about the continuum or life cycle of a private equity fund, you have early years, you sort of have midlife, and then you have the tail or the end of life. We can buy the same fund at different points in time. The portfolio looks very different from year to year. Assets get sold, new companies are purchased during the investment period. After the investment period, assets get sold, assets get written up, some assets get written down. So you have to re-underwrite these things on a quarterly basis. And we have the ability to take a fund that might be second or third quartile and at the right price, turn it into a first quartile type return for our LPs. So it's a different way of thinking about investing in the private markets.
So two things I want to touch on. The first part of your answer, my mind goes to, while this is a nuanced business that's very people-driven and relationship-driven, you have to understand the firm, the partner, how they think about things. Does more data, an evolving technology market infrastructure around things like post-investment, so like valuation, technologies and frameworks, et cetera, as more investors come into the market, as 401ks become a potential way in which people can now access private markets, does there have to be more uniformity around valuations and the way people think about that? And does that at all change in the future, the secondaries business?
I mean, that's a pretty detailed question. I'll try to give a succinct answer. This remains a market where information is disseminated asymmetrically. I haven't seen two private equity firms report the same way. They still report in PDF form. There are definitely products and systems and technologies that are being built to scrape data off that reporting and make it more standardized. But I still don't think we're anywhere near having uniform data to allow for that. And I'm not sure the firms want that to happen. And so far, it hasn't. Now, you're absolutely right. As this asset class finds its way into a broader investor base that is, by most accounts, less sophisticated, we're flying closer and closer to the sun of regulation, which is going to force valuation methodologies and standardized reporting that look and feel more like, probably over time, the public markets. And will that have an effect? Sure. I think it happens in every maturing market. That is, you pick a business, spreads come down over time, right? So it will happen. I don't know when.
Does that also change and evolve the focus of a secondaries firm? I.e., like, does that make something like GP leds, which are more bespoke? And I think at this point, GP leds are now at similar volume to LP leds, which that's a more recent phenomenon. But does what you just talked about then change how like a secondaries firm evolves and what they focus on, and where the kind of the bespoke nature of partnership and working with a firm and understanding aspects of the market that others can't? Is that where a business focuses and makes the difference for their LPs?
It might. Look, this business, I think of this business as about considering the time horizon of these assets and then the hold period for certain investors, which translates to the return expectation for different investors. So I kind of see a market that is going through a period where the hold period is getting longer, so bigger duration. And we're sort of figuring out, well, we used to talk about private equity as a 5-year asset class in terms of hold period, but it really is more like 7 or 8 or 10, right? And so we are creating ways for investors to either be part of the first value creation phase or the second value creation phase. And there's a whole market of buyers out there who buy from people like us who are sort of buying that third. And it may not even be value creation at that point. It's sort of the tail around which you need to price and use structure to get the return you want. But I think that's what's happening. To me, it's less about access to information, and the return's going to be different for an initial investor versus a midlife investor versus a tail end investor. And there's a place for all those different returns and portfolios in one's portfolio. So it's a maturation of the private markets. Just I think in the way you think about investing in a public company that's either a startup, new IPO, growing like crazy versus like a really mature company.
I think that brings us to a really interesting concept to talk about, which is how should investors think about primary investing? So investing in one GP into their fund, most likely a 10-year drawdown fund, could be an evergreen fund today too, or investing in a secondaries fund. And what would be the thought process that an LP would go through, and why would they pick secondaries fund instead of a primary fund? Because it seems like there are some people who are saying that may actually make more sense for certain LPs, is maybe they start with a secondaries fund and that's how they invest. And instead of doing primary investing, they do secondaries investing as a way to get access to the GP or GPs.
We'd always recommend starting with the secondaries fund. We have seen over the years many new entrants to the asset class on the institutional side start by building portfolios with secondary. They do that because it gives immediate diversification, it gives immediate access across fund vintages. It provides sort of a stable ballast part of a portfolio that is yielding from the start, which allows you to mitigate the J curve. You've probably heard that in secondary, cut off the years of early capital draw. And then over time, what those LPs do is they say, okay, well, now I've built this portfolio around secondary, it's cash flowing. Now I will go out and commit to some direct funds of different strategies in a way that I think will generate alpha in the portfolio. Now, the funny thing is what we've seen is some of those come back years later and say, well, turns out I couldn't pick all first quartile managers. Now I'm going to sell into the secondary market and re-up with secondary funds. And so there's a life cycle to it. I think we're seeing the same thing today. You know, there's a tremendous amount of interest in secondary from the wealth market. Same reasons. Diversified, mitigates the J curve. It's all the things people like. You also get to see and touch and feel a whole group of assets that are managed by different GPs. You can look through a portfolio that has all these interesting names, something the wealth market likes. I think if you could wake up and invest in 10 or 15 highest quality GPs across the spectrum, you might not need secondary as a way to kick off your portfolio. But I don't know anyone who's been able to do that. And the minimum investment sizes for those are don't make it accessible to most individuals. And most institutions don't have teams that are capable of doing that at the start. And so it is a great jumping off point, and we really think it should be the core of a portfolio. The one other thing I'd say is I think because this market was pretty small 10, 15 years ago, certainly 20, 30 years ago, investors in the private markets never thought of it as sort of a standalone asset class. And so I think today the secondary market has gotten to a place in a scale where we need to think about it as a core part of any portfolio. You have your primary, private equity, and maybe you have a whole continuum on the risk side of, venture and growth, and then buyout, and then you have secondary, and then you have private credit, and you sort of have all the different parts of the risk spectrum. And so I think we've probably over the years as a market done a poor job of describing secondary as its own asset class. But I think given the scale today and the amount of press around it, the amount of interest in it, and really the need for liquidity, people are starting to wake up and go, oh, like secondary is an interesting investment strategy.
So I think that brings us to some interesting nuances within secondaries markets. So there's some data that would show that single asset CVs sometimes, I think in most cases, outperform multi-asset CVs and then even buyout funds. Correct me if I'm wrong, but I believe there's been data to show that. So, as we unpack some of these nuances of the different ways to play private equity, we could also, there's credit secondaries too, there's infrastructure secondaries. So it's not just private equity when it comes to the secondaries market. But if we just stick with private equity, how do things like single asset CVs factor in, and where should investors bucket that? To your point, should secondaries be its own thing, an own strategy, or should that be private equity and then people kind of think about other aspects of private equity, whether it's directly into a primary of a venture fund or a growth fund or a buyout fund as the satellite around the secondaries as the core?
Well, like any market that is maturing, firms are specializing. We have new products. I mean, we at Lexington have a fund that is focused on single asset CV deals, and then we have our flagship fund, which really does everything, and all of our competitors probably have the same. So as you get more concentrated in a portfolio, one should expect single asset deals and a fund that holds them, maybe 15, 20 companies, to have a higher return profile than a highly diversified secondary fund that has 5,000 to 10,000 underlying companies. And that's the same as an investor on the primary side saying, well, I'm going to pick this manager and that manager versus investing in a primary fund of funds, a traditional fund of funds, where you want diversification I mean, I would argue that a really thoughtfully created private equity portfolio should have some direct private equity, some direct venture, some, direct growth, and then you'd want some single asset secondary and generally funds that do multi-asset CV deals in our market are the same funds that do LP partnership deals, highly diversified. So there aren't really products that do just that. But I think there's a place for all of it.
I want to.
And by the way, what you're going to get in that portfolio of single asset CV deals, the market today, you're sort of getting like greatest hits portfolios because GPs are effectively selling to themselves their favorite assets they continue to manage. And so, it's a nice way to continue to own what are the best performing assets.
So I want to peel back the layer and something you said, which is diversified portfolio may still generate good returns, but it may not generate returns that are as high as a single asset CV, to the point that you made earlier. I want to unpack that in the context of if somebody wakes up and they're just starting to learn about private markets, they might hear the words diversification and a portfolio as being not beta necessarily. I don't want to misconstrue the term beta and alpha, but I want to get to a specific nuance. So let's see if we can get there, which is a diversified pool of secondaries, quote unquote, private markets beta?
It depends on how that diversified pool is created.
So there's a next part to that question, which is, so then where does a secondaries firm look to generate alpha?
So we all create return different ways. There are secondary firms and funds that tend to buy older assets at bigger discounts and with leverage. We as a firm have trended younger in terms of the assets we purchase, where we're creating most of the return for our investors via asset appreciation, not the discount at purchase. We think of discount as a bit of an insurance policy against value erosion. It is not the generator of return for our funds. And then it really is about selecting assets that we know well, that are managed by GPs we know well, and pricing that appropriately. And so it's asset selection.
Is that a different skill set than other secondaries managers may have, where because it brings up an interesting question of what drives the value in a secondaries deal or for a secondaries firm? Is it the discount, or is it the asset selection? And there's some data that shows this may differ based on the strategy, where higher quality assets for certain managers have tended to generate better returns even at lower discounts than higher discounted assets. They end up generating lower returns, which is interesting. That may not be the case with every secondaries manager, but it brings up an interesting question of what is the way, or is there one way to generate returns in secondaries?
Yeah, there is not one way. I think we've been focused on what we believe to be the most consistent way to generate return. I think we've always had a house view that people invest in secondary because the bandwidth of returns across the spectrum, I'm not talking about just our funds, should be pretty tight. And I think it is, if I was the CIO of a pension fund, what would you want? You would want to know that each of the investments you made or the asset classes you've invested in have performed as close as possible to what you underwrote them to. Because then you can think about having different things with different risks and different performance and different time horizons, and you're building a portfolio, right? I think secondary, over its history, has been pretty good in terms of providing performance for the investors close to what they expected to. Like the bandwidth, the band of returns between really good secondary funds and mediocre and not so great is pretty tight. We as a market, as you pointed out before, are in a place where Firms are specializing. You now have single asset deals. You have firms that really focus, again, on buying older assets with leverage. The cost of capital has gone up. So I think over time, you will see that spread of returns probably widen more than it was over the last couple decades of this asset class. So that's a bit of a long-winded way of saying, like, there are different ways to make return. You can buy older stuff, recycle the cash flows, use leverage. You can optimize for kind of three things in our market, right? You can optimize for IRR, DPI, or terminal multiple. And I tell people you can't really have all three. And so, or you can't optimize for all three. And I think what we've always focused on is providing the most consistent investor experience with what we believe to be the lowest unit of risk per unit of return. And I don't think everyone approaches the market that way. Some optimize for early IRR and DPI, and ultimately will sacrifice long-term multiple. That's okay for some LPs because that's what they want. And then other LPs say, no, I really want that long-term return for my pension beneficiaries. So it's kind of like, what are the needs and wants of the LP? How does a GP create, returns? You have a full spectrum.
Does that nuance what you just said, where different LPs may have different needs and wants? Is it worth comparing the secondaries profile of return? I think we can agree that the secondaries and primary fund commitment risk profiles are different because of it's a different product.
Yeah.
But from a returns perspective, do you find that LPs are comparing secondaries return relative to primary return and making a decision to commit to one or the other? Or is that not how they should be thinking about it? Because those are a little bit different.
Right. So I think if you go back 10 or 15 years, they were saying, well, this is coming out of my private equity allocation, and I want that to earn 2.5 to 3 times my money. And that's not what secondary firms provide. And so I think we had to go out as a market and make the case two ways, which is one, as I said before, this is its own asset class. And two, because of the velocity of the capital here, and there's some efficiency to it in that we're returning capital as we invest it, we as a market started to talk about the multiple we can create on the sort of peak contributed capital. And when you look at it that way, the multiples that are being created in these funds are sort of akin to what was being created in buyout. And so, look, that's a bit of a marketing thing. The LP can certainly go, well, I can take that money and invest it in something else. But I think the market generally has woken up and understood that.
I think it's a really important point, though, right? When you think about velocity of capital, the amount of capital that's going to be called at any given time is likely much lower in a secondaries fund than it would be in a primary fund. And then that brings us to the question of, over what time period should an LP evaluate a secondaries fund versus a primary fund if they think about a commitment? Should they be looking at secondaries on a 10-year cycle, and they may have said they've committed to 2 secondaries fund and have compounded that capital, and less capital called, most likely, or maybe over a 10-year period, the same amount of capital called as to a primary
fund.
fund.
The capital, we just are sending capital
and you're sending
back.
it back.
Yeah.
So the velocity, it's faster. How should LPs think about that? Should they be looking at it over 10-year time horizon, a longer time horizon, and then saying, okay, if we committed to secondaries funds at the same pace that we committed to primaries funds over X period, over X number of years, that's how we should evaluate whether secondaries or primaries make more sense?
Yeah, I mean, generally in our market, the rule has been you'd want to commit either twice as fast or twice as many dollars over the same time horizon to get the same amount of capital at work. Yeah, that's the way I would think about it simplistically. Now, to be clear, the time horizons, the hold periods, the duration of all of these asset classes is extending. And so, it may not be exactly that. It'll be slightly longer.
How do you think newer investors to private markets should think about this? And how should they think about this in the context of newer structures? So, as an example, evergreen funds. Maybe if the idea is to compound capital over long periods of time, maybe an evergreen fund makes more sense for a secondaries investment than another asset class or another strategy. So just to kind of illuminate the question in the context of a more concrete example, how should those investors think about it, and how should they think about it from a structure perspective?
Okay. Well, this I could go for an hour here. I will try to keep it short. Most of the private market strategies, and certainly secondary, have benefited for decades from this archaic structure, which is the private equity fund. Locked up capital, where the firm, the GP, has 4, 5, 6 years to invest, and in a longer period to return, capital to the LPs, presumably, at a higher value than what they invested, right? And that structure has protected the investors, the LPs, from their worst instinct, which is to buy at the top and sell at the bottom. So I think that is a great structure for this asset class. And I would say the same for secondary. Direct private equity, certainly, but also secondary, because, think about the nature of our deals. We're going out and we are negotiating with pensions and endowments and foundations and other private equity firms. And it takes 3 to 6 months to source, due diligence, negotiate, execute these deals. You need patient capital waiting for you to do that. And sometimes the duration of these deals is longer or shorter than expected. And to have that, locked up capital is a really helpful thing. Now, we have recently, about a year ago, created an evergreen product for our strategy. Ours is actually across both secondary and co-investment, which we haven't talked about. The other strategy we have at Lexington. It is evergreen is very attractive to many of the newer entrants because you can get all of your capital to work at once. It is a more simplified tax reporting structure, and importantly, it provides the option for liquidity when the investor wants it. That is. So look, I think it's a very attractive structure. Personally, I think to invest in our asset class of secondary, to successfully deploy an evergreen fund, you also need a very large drawdown fund. Because of that dynamic I suggested, which is we're negotiating deals where we need to know how much capital we have to invest, and we need to ensure that the capital is there to go close a large deal that's $1 billion or more with an endowment, let's say, 3 months from now. You can't go to the endowment and say, okay, we're agreed on price. We're going to go negotiate all these transfers with the GPs. Trust us, the money will be there in 3 months based on the flows we're seeing. So there are challenges in the evergreen space, which is you are investing against an unknown denominator in terms of pacing and portfolio construction. We as a market haven't yet seen real outflows of capital, but that will happen at some point. So now the flip side is, because of the diversification and the sort of recycling of capital nature of secondary, it can be very powerful in an evergreen fund. Like maybe that is a better structure once you get to scale for this strategy, We don't know yet. It's pretty new, but look, I think over time, the way we've approached it is we're going to keep doing the same deals with the same people, the same process, and we're going to leave it up to the investor, institutions mostly in the drawdown fund probably, and individual wealth, retail type capital in the Evergreen fund, but there will be both in both. We're going to leave it to the investor to decide what structure makes sense for them, and we will just keep delivering product into that.
It's not just the Evergreen fund that raised a good amount of capital from the wealth channel. In your last fund, after you ended up partnering with Franklin, I think it was 20% of your $22 billion fund, roughly or so, was the wealth. Was wealth capital, which is a really sizable amount of capital. So it's not just Evergreen funds that the wealth channel is choosing; it's also drawdown. And I think that brings us to an interesting point about scale. That's where my mind goes when I hear you say the importance of being able to do an evergreen strategy well in secondaries requires a drawdown fund as well, because you need the size and scale to be able to commit to a deal on an LP led or GP led, I imagine, as well.
Well, the way we think about it, and part of the rationale behind the creation of the Evergreen fund, it's just additional capital that amplifies our buying power. Again, if you're doing the same deals through the same process with the same people from the same pipeline, and we as a firm and a team are agnostic as to whether it goes to the drawdown fund or the Evergreen fund, showing up with a bigger checkbook gives you the ability, to your point, to drive better terms and buy better stuff for our LPs. So it is a market. It's a bit counterintuitive because there are not many investment strategies like it where scale helps you drive better returns.
Brings us to another interesting question, which is, what is the skill set required to be a great secondaries investor today? Because we talked about early on in the market, $1 billion transacted 25 years ago, now 200 plus billion. So the market's gotten bigger. What's the skill set that's required to be a really good secondaries investor?
I don't know. I wish I had it. Certainly my partners and colleagues do. No, ours is, you need a nice mix of qualitative and quantitative IQ and EQ. I mean, this again is a business where we have to understand the needs and wants and alignment we have with the GP who manages the asset. We have to understand the same with the LP who is selling to us. As we do our diligence, we need to be able to speak to and work with management teams of companies to understand, the assets we are buying. And you have to take huge amounts of information because we're generalists and distill it down, to what makes sense for us from an investment rationale. And then we have to communicate that to our own investment committee internally and our partners and colleagues. And so it's very different than, like, if I have friends who are hedge fund managers and they can hire incredibly brilliant quantitative people, and that operates in a market, public markets, where information flows totally symmetrically, right? And so, but this is not that. We need to hire people who, at a very junior level, can get on, a Zoom with the head of a private equity firm and the CEO of a company and ask really thoughtful questions and tease out the information we need to make the investment decision. And so it's kind of like you get to use all the different tools in your toolkit. And I think that's what and the other thing that I think makes people in our business and certainly at our firm really successful is just intellectual curiosity. This is a market that's growing really fast. It's a market that's evolving. I said at our annual meeting in front of all of our LPs, one of the things that excites me the most is, like, when I think back to 2007, when I started chasing the founder of our firm for an interview, I don't think many people were thinking about secondary. But today, because of the growth of this market, we're getting inbound resumes from associates who are direct investors at some of the best private equity firms out there. They've done their years of investment banking. They're already doing direct private equity. They've sort of gotten to the top of the peak of where their friends are in terms of success, but they still want to go work at a secondary firm like Lexington because they find it interesting. And so, look, it takes sort of, you need the full toolkit to be really successful in this business.
Knowing what you know now, if you were starting or early on your career journey in secondaries today, what's the most underrated or underappreciated skill set or trait that you would say would make for a successful secondaries investor?
Oh, God, that's a good question. Look, you have to have a base level of quantitative skills that allow you to execute the strategy. But what makes, people really good at this, I think, is honestly being someone who others want to work with. It's not complicated. And I say that to college kids, and I say that to our summer interns, and I say that to people we work with. Just showing intellectual curiosity, being a self-starter, and then being someone who others want to work with gets you invited into the room for that conversation. You become part of a deal team organically. The next thing you know, you're leading transactions, and you can sort of, that goes outside the firm, right? So we work with tons of other private equity firms and growth and venture firms. We also do a lot of business with repeat sellers to us. 40% of the deals we do are with repeat sellers to us, showing up, being professional, being a reliable person, a reliable firm, a reliable counterparty. And again, it goes back to just being someone who others want to work with. Incredibly important.
I think that answer is so illuminating because it also kind of encapsulates.
You got me all choked up. You got me all excited.
But it encapsulates where we are in private markets. Like if you think about the industry trends, like to do secondaries well, at least something I took away from your answer is you have to understand the industry and the industry trends, the industry players. You may even have to get good, maybe major and minor in certain sectors or strategies, right? Like the understanding aspects.
Some specialty.
You want to be a generalist. I think you've said that before as well, but you have to know all of these things. And there's so much happening with GP consolidation and the evolution of asset management as businesses. And that's maybe that's driving how GPs are thinking about investing or
for sure. I mean, it's a great point. I mean, you say you're underwriting a fund managed by a GP and that GP sells a stake in their business. What does that mean about the behaviors of that GP go forward, right? I mean, even something as little as that is important for us to consider, and we talk about it at our investment committee and as deal teams as we're. So yeah, you sort of have to be both really wide aperture, but also really drilled down.
You could say the same for the wealth side too, right? Like as wealth investors become larger LPs, there's large wealth platforms, there's private banks, there's independent RIAs, all of whom may think about investing in private markets differently. You have institutions who may, talked about this as well, but geopolitical reasons may have to sell for reasons totally outside of their own control, right? And all of those things probably come into play as you think about how you approach the market on either the GP or the LP side.
For sure. A need for liquidity is not the only reason why people sell. There are political reasons. There are, a change of CIO, you name it. And so you sort of have to keep your eye on all the balls at the same time. It's a real juggling act. And, I think one of the things we did really from the start, we've always had our senior investment people increasingly alongside our investor relations team out talking to the LPs. And because you go into these conversations and you may be talking about our next fund and the LP may say, well, that sounds really interesting, but turns out we have a bit of a liquidity issue, or I have a new boss, the CIO, who wants to divest, and all of a sudden you've sourced a deal, right? So I think that's where you're going. You have to have your eye on the entire playing field, You have to be a bit of a specialist, but at the same time be able to, know what's going across the whole private market spectrum, know how to price the risk. Again, it goes back to, and look, one of the things we focused on at Lexington for a long time is the training and retention of our people. We don't lose people. And it is important because you want that, incredible muscle memory and pattern recognition to stay within the firm.
Where does this all go from here? What do secondary markets start to look like? It's not small in size and scale by any means today.
To be clear, even at 200 or 210 or 15 or 20, whatever it's going to be, $1 billion a year, it's still tiny.
It's only a few percent of the
It's only a few percent relative to the private market. So, the secondary market can never get bigger than the primary market. That's math. But the primary markets are growing faster in terms of NAV than the secondary market. And it, so I don't know where it goes, but it definitely continues to grow.
The other aspect of this too, and we touched on this a little bit earlier with scale, secondaries funds can probably get larger in size and scale. LCP 10 was $22 billion roughly.
Yeah.
The largest primary private equity fund, I think it was CVC, was close to 30 US, 25
yeah, something like
euros,
that.
close to 30 US.
Yeah.
That probably feels harder to get much bigger.
Yeah.
Maybe a little bigger, but much
It's
bigger.
hard raising money,
But, A secondaries fund feels like it could be bigger.
Yeah, I mean, if you leave aside how hard it is to raise capital and all the politics and around that, just in terms of strategy and opportunity to that fund, there's no reason why you couldn't have a massive secondary fund, 30, 40, $50 billion. It would be, I kind of joke with people internally, we could have a fund of that size and there's no lack of deal flow to deploy that. Actually, even with our last flagship fund, which at the time it was raised was the largest ever in the market, our issue has been not investing it too fast. It's been making sure we maintain real discipline in terms of the deployment. We are not smart enough to time markets. We've always tried to deploy the funds in a fairly linear way over the investment period. And I honestly think we could have deployed a fund twice that size without giving up much in terms of projected return. So I think that is probably the truth, but I do think we as a market are bumping up against what's possible in terms of just capital raising.
I think what's possible, that brings me to another aspect of the secondary markets, is the fact that there are probably some misconceptions around certain aspects of secondaries. What would you say are some of the biggest misconceptions that people have about secondaries markets?
One, I think people get a little too focused on this notion of discounts. Again, I said we as a firm generally, not generally, we don't create return via discount. It's from asset appreciation. I think in talking about discounts, people think of this as an opportunistic asset class, which it is not. There is always someone selling for some reason. There is always a need for liquidity somewhere. And so we have shown as a market that we can produce very attractive returns irrespective of where we are in the pricing cycle. I think that is probably, I go out into the market with our partners at Franklin, and I talk to a lot of financial advisors who are newer to this than pension staff and institutional investors. And they always ask, well, where are discounts today? And, it seems like the market needs liquidity. Can you really, this market is sophisticated enough, and the sellers to us are sophisticated enough where they know what they're selling and it works for them, and we know what we're buying and it works for us, and it is not opportunistic or episodic anymore. It is a more mature market than that. So I think that's the biggest myth that people have.
how do people shift their mind from this is a discounted investment strategy? We're to your point, I think people might think, okay, this is about discounts, secondaries. People have to sell. They're for sellers. Versus,
I think they just need to spend the time looking at the pricing cycles and the track records of these of managers. I'm not just talking about Lexington. As an asset class, I think they need to look back at what is now a real history of this asset class and look at how through market cycles, the returns we've been able to produce have been quite consistent as a market. And, I think that is, I suspect there were not enough GPs and funds and data points for them to do that. But today there are, right? This is a real asset class. And so I think, that probably gives them more confidence to commit more dollars. And the market has gotten to a place size-wise where we have new entrants and more data points. So I think they'll get there, but I'm not sure I can change people's minds without them looking at the data.
You said it, which is this is a real asset class. And I think the journey you took us through from the start of your career, even going back to Lexington's founding history, the evolution of the industry, how small it was when Lexington started, even when you started in the business, to today, I think that illuminates that secondaries are certainly here to stay, and they are on the forefront, if not a primary way in which people think about investing in private markets. So, Taylor, thanks so much. It's a fascinating conversation.
Michael, thank you. No, it's my pleasure, and hopefully you sense the excitement, and I think there's a lot of tremendous growth.
Absolutely.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going